Hey traders, welcome to Charts and Coffee. Hope everyone is having a good morning. Happy Tuesday, everybody. Welcome to our daily pre-market show. All right, couple things to take a look at before we get started with your questions, of course. And that is a quick look at the economic calendar. Again, remember that we have two calendars that we're keeping an eye on right now as we go into earnings season, Estimize, and then also whether it's trading economics or Forex Factory, preferably both. You're keeping an eye on those hot zones. You know when those high impact scheduled events that are going to be volatility, shakers occur. Today, pretty quiet, which is good. It's not going to create any setups that I call first come first serve. We get a dramatic move in one direction or the other, and we fade it. I love to fade. Where's my Darth fader? There we go, Darth Fader. We're doing a lot of fading in this environment. We're taking a look at where volatility and time edges are, and we take advantage of the move that's likely exhaustive to those edges. A lot of you have the HPMRs, and hopefully you've been noticing how well they do recognize, capture those edges that really nothing else will, because it's looking at price to a very different lens. So nice, quiet economic calendar. We had a pretty quiet economic calendar yesterday as well for our live trading for the day trading survival guide class that's going on still right now. Had a couple nice trades, but again, a little bit more sedate, which after Friday, non-farm payroll volatility is certainly more than welcome. So nice quiet calendar should make for some good, less frenetic trading today. As we open the session, the indices are heading lower. This works really nicely with open shorts that we have in the Sector Secrets Mastery in XLC and XLF. And I say open shorts. What they are is they're long put positions, taking advantage of the movement lower. So we'll continue to surf that wave to the downside. And that's pretty much what I've got going on in my book, whether that's short-term day trading book or whether it's a long-term swing. We always like to keep an eye on that. And then today at 3 p.m., we go into our slightly longer term view where I'm going to get into multi-charts. We're going to get into some of the weekly time frames and look at what some of the trends are doing there. And if you caught the video that I did Thursday, you can check it out at the Simpler Trading YouTube channel. I talked about the light at the end of the bottom. What am I watching for a bottoming process? Not a V bottom, not picking the bottom. That's just delusional. That's a delusional approach to analyzing the market. We analyze, we wait for processes, we wait for our checklist, we wait for multiple things to point in the same direction. We just don't come in with bravado and say, here's the top, here's the bottom. Good luck with that. But there might be a career in television for you if you like doing that stuff, maybe just not as a trader. So we'll be doing that today. Longer term time horizon position trades with an understanding of macro and how that affects those longer term time frames. All right, so got lots going on today. As always, thanks for being a part of the show. It's time to get into those questions. All right, kicking it off with Julian, who asked me, take a look at KBA. Sure. All right. And double green, yes. Agro, yep. Now there's two things here that we can look at with KBA. And one is the 21 propulsion. The mean, the retracement, the reversion to the mean is the 34 EMA wave for me. Remember, there's no accepted, this is the mean. It's just what we all individually consider a useful sort of average that the market's likely to come back to. Home base, if you will, right? So 21 is an aggro version. The wave is a more conservative. Yes, this is a good look at what could be a sinking down into the wave. I'd wait for the wave. I would wait for the wave on this because it looks like you're going to get slightly lower lows by about 30 cents this morning, and that's going to put you in the wave today. All right, so find the trend, follow the trend, whatever the reasoning may be, Julian. Remember, the reason has to be seen in price. So there's always narratives in a market, right? The narratives are fine, but narratives are not trades. Narratives are not setups. If we see the narrative and we can determine if it's bullish or bearish, and then we can look at price and we can see whether it's playing out bullishly or bearishly, then we're in good shape. So I like the technical structure on that one. Good stuff. All right, next up, since the FDA reduced, what's the question here? All right, so is there a potential increase in feeder cattle in the near future? So James, I'll kind of answer that. Cool narrative, right? Very cool narrative for feeder cattle. If you're looking at feeder, or really anything, and there's a narrative, again, then we take the narrative over to the chart. And if it's playing out bullishly, then yes. If we're in chop, not so much, right? Unless you can get an oversold buy. So always ask yourself, what does this narrative mean to me? And then go check that in price. And I think ultimately what you'll find is you'll know to both your questions, Julian and James, great trades usually have a story. That is true. But great trades also have a setup. That means that there's a setup that's syncing up with that story. So if you have this story, whether that be China in your question, Julian, or whether that be feeder in your question, James, then check price. And then if you can do that, if you can check both those boxes, you're in very good shape. Next up is bonds. I don't expect new lows in bonds. I am looking for a little bit more chop because it seems that the upper end of the target rate probabilities are going to affect the yield curve continuing to move higher. In other words, we kind of know where the Fed's going to stop now. We can see where it's leveled off, and that leveling off has held steady through multiple high impact hot zones affecting jobs and inflation and even FOMC meetings in minutes. Very unlikely we're going to continue to new higher yields on the 10-year or on the 30, and that means likely not lower lows on ZB and ZN. But is the trend that preceded the chop bearish? It is. I will still give an edge, although slighter, but I will still give an edge to the bears who want to short off ceilings, and that's going to apply to both the 10 and the long bond. Peter, yeah, it'll apply to both. Is crude still in a chop? Yes, neutral underlying market. Take a look here. Yellow lower row of the multi. Yellow trend trade flag. Yes, it's still looking at bouncing off a number of support levels. You've got some Darvis 2.0 levels in there. You've got the 200, which, by the way, also has a Darvis in there. Take a look at that. Let's clean this chart up a little bit. Let's grab our horizontal drawing tool, overlay that, and I'm overlaying that right over top of the Darvis. So that's a Darvis. That's a Darvis support level. So this is Darvis 2.0 support. Boom. In that zone, we are increasingly oversold in a neutral market. Structure dictates strategy. Strategy dictates indicator. So I'm not just going on over to the slow stochastic because it's my favorite secret squiggle. I'm looking at it because we're in a choppy market, and that is the decoder ring. That is the decoder ring for the chop. Now, you might say, Rag, if structure dictates strategy and strategy dictates the indicator that we're going to use, well, then what dictates structure? How do I start with that? Remember, you want to use the grab candles. you want to use the wave. If you've got the trade flags, that's your color-coded traffic light for structure understanding. Even better is the multi-trend, which is the history of the right here. You see momentum and trend. It's really the history when you go back of momentum and trend. Structure is how traders are thinking, sentiment, bullish, bearish, the momentum, what they start to do, and then trend. And if sentiment and momentum continue, you end up with the end result is a trend. So remember, sentiment plus momentum equals trend. And you want to look at momentum and trend. And so we use some really easy tools, color coded to do it. It's just about as easy as it gets. Neutral market and oversold buy would be preferable. Joseph, so good stuff. All right, next up, are my open to shorting ag futures? Am I avoiding them right now? Well, go back to structure strategy indicator. Double red means, yeah, I'm open to it. You see the red momentum, red trend, gang? Front man, look at the red over red on the multi down here. Where are my drawing tools? That's what we want to focus on, right? So I've got the red over red here, got the red here. Short the rip works. South of the propulsion, that's corn. Here are beans. Downtrend. Wheat, downtrend, right? So yes, I want to focus on the short side. Bean meal. So I'm looking at some grains here. And, well, no, actually ZM meal is not in a downtrend, but it's south of the 200 propulsion. So yes, structure dictates that would be the highest probability. Do I use zero? No. Yeah, Nick, that's an easy no. I don't. If there's a day trade to be had, I'll day trade it, right? I'm not going to play. Look, there's high probability and there's low probability. For me, in my opinion, that's a low probability. If there's a trend, I'm going to be able to find that trend. I'm going to be able to recognize that the market's generally moving higher or lower. That's part of the process. Or maybe I'm playing the edge, right? Let's take a look at the S&P, for example. Let's go take a look at ES futures. I'm going to recognize the trend. I'm going to preferably move with that trend. I'm going to preferably find support zones within that trend. I'm going to continue to confirm it throughout the day because many of us know the morning trend and the afternoon trend can be, it feels like they're two different planets, right? It can feel like two completely separate days. So if there is an opportunity to take advantage of premium decay, that's just one tiny little checkbox. So I want to at least explain my process. If I can take advantage of a low-cost option that's going to expire today, Monday, Wednesdays, and Fridays, cool, I'll do that. But there's got to be a setup. So as a general rule, that's a big cup of nope. No, I do not. All right. Next up, is there any thought to do something like non-farm for the CPI? Maybe. I'll let you all know if I'm going to do that. If I do, I'll be in the elite trading, which is the last day of trading for the class that's coming up. For any of you that have been wanting to get the HPMR, I would do that before Friday, because if you do it before Friday, you'll get a year of updates and the class and the indicators that came with the class. So it's just the best bang for your buck. Do it by Friday. And then maybe, I'm not sure, Alan, if I do, I'll alert it probably by tomorrow. I'm leaning towards doing that for it's core retail on Friday. So if you're taking a look at Friday's calendar, it's core retail. That's what's on Friday. CPI is actually Wednesday. All right, next up is Greg. I reviewed your video on the basis for a potential bottom theme. Well, thank you, Greg. I appreciate the time. Like the content? Well, thank you. The issue is more about net earnings for the next 2 quarters. Not sure to project those earnings. I actually do not pay that much attention. I know, Greg. But since you watched the video, I'm going to stay true to my macro analysis. I actually don't care how earnings do. I really don't. And here's why. Yes, we're going to see. Remember, as earnings come out And once more and more of a larger percentage of the S&P earnings are there, we're going to see that organize into a trend, likely on the S&P, likely on the NAS, likely on the Dow, based upon the heavily weighted stocks within those sectors. So truly, a very small number of stocks affect the broader markets. Almost, actually, every single high concentration weighted sector within the indices is also high concentration weighted by stocks. In other words, a very small amount of stocks move the sectors, and a very small amount of sectors move the indices. And the indices are also high concentration weighted as well. So to look at general earnings, or to look at any study that looks at a large group of stocks without their weighting, really doesn't measure what the market does. So that's why, for me, I'll trade earnings, but I really don't care what they are, because frankly, the only macro that matters is the Federal Reserve. And to the Federal Reserve, the only trend, rate of change that matters is really three prongs: jobs, inflation, growth. And that's the way I look at macro. I don't view earnings as a main macro pillar. Are they important? Not as important as some traders might think. For me, it's never made a difference, because the Federal Reserve is going to be looking at those macroeconomic, right? Macroeconomic, jobs, inflation, growth. And so for us, I think trading earnings is potentially a lot of interesting volatility. You can check out the way that I trade earnings, by the way, gang, over at countdowntrader.com, where we have a couple updates that Trish has outlined beautifully, called the 642 earnings window. And so, yeah, I agree, Greg, that psychology absolutely will be affected by earnings as we round out the rest of this year. But watch the data points. It never hurts to look at some of the near-term earnings psychology, but it won't eclipse what is happening at the inflation front, what's happening with the consumer, what's happening with the consumers keeping their jobs, are more jobs opening, things like that. Remember, our Federal Reserve has a dual mandate: inflation and jobs. So great comment. I just typically, personally, don't pay that much attention to earnings as an important main macroeconomic pillar. So just, want to make sure hey, Rog, you're not mentioning earnings. That's a trading event for me. All right. And thank you for the comment. Good stuff. I appreciate that very much. Thanks, Greg. All right. Next up, is it better to trade oil stocks like RIG and KMI in an uptrend as opposed to a downtrend at CHOP? I wouldn't separate out, Al. I wouldn't separate out two stocks. Almost anything is better to trade in an uptrend. Uptrends psychologically are more predictable than downtrends. And CHOP is, frankly, in many ways, probably the most difficult to trade. Easiest to trade are uptrends. That's why everyone did so well in 2019 and so well in 2020. 2021 got tricky. In 2022, everyone's crying. Why? Uptrends are just easier to trade. Downtrends are nice, but they're not as easy to trade as uptrends. And most traders don't actually acknowledge CHOP. They still want to treat a broken uptrend as a downtrend and a broken downtrend as an uptrend. So they look at the market in a very binary up or down way rather than acknowledging CHOP. So CHOP can be tricky because most traders don't acknowledge it. So I would not separate out RIG or KMI from, looking at anything in an uptrend. So I'm not quite sure the angle on that question, Al, but no, I would, just generally speaking, Al, I would not separate out stocks. Or I wouldn't separate out any sector. I would just say uptrends, to your point, are always easier to trade than downtrends. Do we have that many uptrends right now? That's what we don't have. So what's been difficult about this market? The easiest market structure to trade is also a very quickly receding pool of symbols, right, that have an uptrend that we can take advantage of. All right, next up, JP, how are you? Is there any meaningful link between stock, indices, and currencies? Of course. Sure. Of course. Stock and indices, of course, right? Stocks make up the indices. Stocks make up the sectors. And currencies, I will look at, and by the way, JP, let me address the last part. Almost no market is independent. No, nothing is on an island. Nothing. There might be moments where some stocks are a little bit more disconnected from broader averages or from broader risk appetite or risk aversion or sector rotation, but nothing trades on an island. No, nothing at all. You might say, what about penny stocks? Things like that. They do really well when we have super accommodative monetary policy. So we cannot disconnect. No, I don't believe so at all. And I don't want to find disconnected markets. So is there any link? Absolutely. Is it meaningful? Currencies are the biggest market on the planet, right? When we get a feel for where Australian dollar or Japanese yen are going, we will have a better idea if people are feeling like they want to buy stocks or like they want to sell stocks. We'll get a better feeling for risk aversion or risk appetite. So absolutely, absolutely. Yes, there it is. All right, gang. And boy, good questions today. I appreciate it. I'm out of time. I'm going to be heading over into the futures room. So I'll see you all there shortly. We'll get the notes out for today. Again, remember, if you're a member of the Sector Secrets Mastery in the days when I'm in the futures room, you get I call them notes. Cumulatively, it's a newsletter. You get it by simply being a member of the room. If you like to keep those notes, put them together every week, and you've got essentially what I'm looking at when I'm trading for the week. So heads up for that in the futures room and the Sector Secrets Mastery. If you've been wanting to kick the tires on what we're doing in either room, come on over. Take a look at what we're doing, see if it's a right fit for you, right? Make sure it's something that is going to work for your plans in your trading career. I think it will, though. All right, gang, have a great one, and I will see you tomorrow. Same time, same station. Be good to each other.